Hey guys, welcome to my channel. Brad here. So today I want to talk about risk. What is risk when it comes to investment? What is risk in investing? So most people think that risk is the same as volatility. That's what they teach in academia. That the more the price fluctuates for a stock, the riskier it is. Well, the benefit of measuring risk through volatility is that it's easy to calculate volatility. It's very simple and straightforward. The problem is the risk that we care about as investors is the risk of losing money, okay? It's not how wildly the price of an asset fluctuates. In fact, it could actually be beneficial for the price to fluctuate a lot. If we can get in at the price we like for a stock, if the volatility is higher, we may be presented with a price that's a compelling price to sell at more quickly if the stock is more volatile. So, in my opinion, this guy here, Howard Marks, now he's got 3 chapters in this book, the best discussion of risk that I've ever seen. I would highly recommend you check this out. But it just doesn't make sense for me or for Howard Marks to see risk as the same as volatility. Risk is really, the reason we're investing, we want to put money down today on something that will grow our money over time, right? So the real risk when it comes to investing is losing money. That's really the only risk we care about. Now, okay, so how do we address that as investors? Of course, Buffett is famous as having said, rule number 1, don't lose money. And we all know rule number 2. So it's obvious that risk of losing money is very important to Buffett. But what does it mean? How can we think about it in terms of investing in our own portfolios to manage risk, to minimize the risk of losing money? Well, I'm going to read you a few quotes. One is by Charlie Munger. It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So one thing that happens in investing is that people, they try to pick companies that are just going to knock it out of the park, right? Long shots. Companies like Tesla, companies like, these startup kind of companies, Beyond Meat, companies where these companies could be incredibly massive one day. There's a huge could potential, okay? But because they're in startup mode, there's not a lot to go off of in terms of financials in the recent past. Most of it is projecting, 5-10 years into the future. That's where the meat of the investment is going to come from, 5-10 years into the future. Now, when you pick an investment like that, there's what people tend to not take into account is for any investment, there are a number of possible outcomes in terms of how that investment is going to play out. Both micro factors, both business level factors and macro factors, okay? So let's talk about, return versus risk adjusted return. So let's say we have an opportunity where we have a 10% chance of getting a 5x return on our money, say in 3 years, okay? 10% chance of 5x, 80% chance of a double, and a 10% chance of losing everything, going bankrupt. The company's going to go bankrupt in 3 years, 10% chance. Now, to understand the return, now the real return is going to be whichever of those possible outcomes happen, okay? So I'm either going to get a 5x in 3 years, I'm going to get a 2x in 3 years, or I'm going to lose all my money. Those are the 3 options. Now, a risk-adjusted return is considering how much risk is taken to get that return. So the way to calculate a risk-adjusted return in this case would be to say, all right, there's a 10% chance of 5x, an 80% chance of 2x, a 10% chance of 0, and you weight those, and you get about a 2.2x over those 3 years. So that would be your risk-adjusted return. Now, in order to come up with an accurate assessment of how risky an investment is, you really have to know the business, okay? That's why risk is so hard to quantify. It's really about the skill of the investor to assess what the probable outcomes are, what the likelihood is of those outcomes, and make investment decisions based on what could happen, not what's actually going to happen. And there's a quote I want to read to you here. Risk means more things can happen than will happen. Okay, that's by Elroy Dimson. So the tricky thing about assessing a manager's performance over time is that, you know, if you're only looking back, say 5 or 10 years, and there was no, say, recession or crash in that time, and you're looking at a manager and they've gotten, 15% annual returns, and you think, wow, that's really good. The problem is you don't know how much risk they're taking to get that 15% return. It's possible if they had been using that same approach over the last 15 or 20 years, and there were a couple of recessions in there, that those recessions would have exposed the higher risk that they were taking to achieve the returns. That's what Buffett meant when he said, it's only when the tide goes out that you can see who's been swimming naked, right? Once the tide goes out, once there's a crash, once there's a recession, the people who were taking more risk, the people who are using leverage, blow up. Their portfolios blow up because they were generating the returns by taking more risk, not by selecting investments more skillfully, okay? So this is really the thing to wrap your head around risk. It's always there, but only the skillful investors are aware of it and know how to assess it appropriately. And the real way so a lot of people think the more risk you take, the higher your returns are going to be. Well, that's often true when we're in a bull run, when the market is going up. But clearly that's not the case when the market goes down. The more risk you take, especially if the reason the market went down or the particular sector of the economy that gets hit hardest by that particular recession, like in 2008, it was real estate. So if you were taking risk in the real estate sector, if you were using leverage in the real estate sector, you got particularly spanked in 2008. But the way that Buffett addresses risk, what he says is if you buy things for much less than they're worth, and you buy, a group of them, you basically don't lose money. So the whole idea there, he's a value investor. If you buy with a margin of safety, if you can reasonably estimate what the intrinsic value of that business, what that stock is, and then you can buy that share at a price that's significantly lower than the value, however you value the company. If you can do it, reasonably accurately, and the less accurately you can do it, the more margin of safety you need, the more of a discount you need in order to protect your downside, to protect your risk of loss. So, that's really all there is to it in terms of addressing risk. Addressing the risk of not losing money is to only buy companies that you understand, because when you understand them, you can come up with a reasonable value for them. Only buy companies you can understand. Buy them at a significant discount, and buy more than one. You don't need to buy many more than one. I would say 5 to 10. If they're businesses you understand and you can get them at a significant discount. If you own 5 to 10 stocks, you don't need to do more than that. And actually doing more than that can actually hurt your portfolio because you're essentially pulling money away from your highest conviction ideas, the ideas that you feel strongest about, that they're great investments. You're diluting those potential great returns with ideas that you're not as convicted about. So yeah, I think that's pretty much what I wanted to say about risk. Risk is not volatility. Risk is understanding how to lose money and how not to lose money. And the way not to lose money is to buy at a significant discount, only buy things that you can reasonably value, and make sure you get a discount from that. And then own a handful of them. You really don't need more than that. So this is my kind of discussion of risk. Again, this book, The Most Important Thing Illuminated by Howard Marks, chapters 5, 6, and 7. Just an incredible treatise on the concept of risk and how to approach it. And Howard Marks, he says controlling for risk is more important for him and his firm than chasing companies that are going to get him high returns. And the reason for that, if you lose 50% on an investment, you now have to get 100% return to get back to even. Okay? So the long-term performance of people's portfolios tend to be influenced more by the number of losers that they have and the magnitude of those losses than by the winners. So, it may seem like kind of a dry topic, risk, protecting the downside, but guys, it is absolutely critical. You want to get to financial freedom and you want to do it, in a timely and intelligent way. You've got to pay attention to the risk of losing money and minimize that as much as possible. And also I want to mention, a lot of people think, the more risk you take, the higher your returns are going to be. But it's actually true. If you get a stock at a significant discount from what it's worth, you are both minimizing your risk and maximizing your return. So it's possible to do both of those things at the same time. And not a lot of people know that. They think, well, you got to take more risk to get more returns. Well, that's actually not true. It might be true if you're talking about an efficient market, but clearly the market isn't 100% efficient. So that's all I got to say about risk, guys. Let me know what you think about risk. Let me know what you're doing to control risk in your portfolio now. At a time that's very uncertain. We have no idea what's going to happen the next 3, 6, 12 months in the markets. It's kind of a weird thing that, all these jobless, unemployment numbers are coming out, and the stock market it's taken back off like a rocket ship. So it's just a fascinating time to be in the markets. But anyway, guys, hope you enjoyed this. Let me know below if you did. Smash that thumbs up button to help the algorithm, and be great if you subscribe. I'm trying to build my subscribers up to 1,000 so I can get monetized and kind of share my journey around that with you, let you guys know how many videos it took to get monetized, and just be as transparent as I can be with you guys about what it's like to build a business on YouTube. So anyway, take care, guys. I'll see you in the next video.